Good morning, afternoon, or evening to all, and welcome to another of Sonen's Impact Framework webinars. I'm your host, Amando Balbuena. I head up marketing for Sonen Capital, and I'm sitting at my desk here in the peninsula just south of San Francisco on what is a warm and sunny February day. Also with me in our Mountain West office is Sonen's Head of Impact, Will Morgan. Good day to you, Will.
Good morning, Amando. Hello, everyone. Thanks for coming today.
To our audience, we very much appreciate your time and participation today, and we encourage you to use the Q&A function to submit your questions. Throughout this webinar, we'll be reviewing the questions and answer as many as possible during and at the end. As such, we're aiming for a 20 to 25-minute presentation, and in answering the first question, yes, we will be recording this, and yes, we will be sharing it with you afterwards. As I said before, I'm joined by Sonen Capital's Head of Impact, Will Morgan. Will has been working in the field of impact measurement for 15 years, and he leads Sonen's efforts to define, evaluate, and report impact across Sonen's public and private market investments.
Thanks, Amando, and thanks, everyone. Good morning, good afternoon. Thank you for being here today. So much has changed in this particular industry in the last 10 and 15 years. It's an exciting time to be discussing some of these things. And in the aftermath of COVID and the enormous economic hit it has had globally, and in particular for poor people and underserved populations, we're glad to be discussing this and talking about how we can rebuild this economy for everyone.
Thank you. Indeed, Will. One thing we should address before we dive into our goals around financial inclusion is that there are actually many theories to financial inclusion, some well-known, most not, but what they have in common is the ease of access to and availability of basic services for each and every member of a given population. There are different policies, practices, and perspectives designed for different geographies. We're not going to go through those different theories here today. We're also not going to debate right or wrong, because within the topic, there are just too many detours that we can take from discussing how increased access, for example, can also increase over-indebtedness, or how increased access can even conflict with our own sustainability goals because of increased consumption. Rather, we'll say the debate about how best to meet the financial inclusion needs of all people should absolutely be had. With that said, the intention of Sonen's framework is to highlight three outcomes: expanding access, improving affordability, and building considerations of sustainability into all of our investment decisions. And our goal for today is to show you a path from the objective to the investment strategy. Will, this is our 8th impact framework. Can you tell us a little bit about Sonen's framework methodology and why we are using and sharing these tools?
Yes, I can. Thanks, Amando. In short, as Amando mentioned, we've published 8 of these frameworks, and what they are really intended to do is to articulate the things that we want to achieve as a result of our investments. We identify the long-term outcomes that we seek, and then we identify investments that we think will help those outcomes manifest. This may seem elementary, particularly for this audience, but one of the most important tenets for an impact investor is to define what he or she is looking for. What do you want to achieve with the investments that you make? At Sonen, we've tried to keep it simple and straightforward. We define investing for financial inclusion to mean investing in affordable and effective and safe services with the goal of creating positive social, economic, and environmental impacts. So with that backdrop, here's some more context. We see an enormous addressable market for this issue. First and foremost, this market has been largely underserved, and this is why we are here today discussing this. There are 2 billion people around the planet who lack access to basic financial services of any sort. Every year, small businesses are looking for $5 trillion in financing and credit that they are unable to find. A full third of women around the world are just absolutely excluded from the formal financial system altogether, and our current financial system is inefficient. We need to make financial decisions now that don't require us to spend more money to go back and fix some of the problems that we've inadvertently created. We also know that investing in financial inclusion can bring seismic benefits to people who are previously excluded. When women, for example, are offered simple bank accounts, something as simple as a savings account, their total assets increase by 16%. That's actual data. Rural poverty in India was reduced by a full 17% when the government made an effort to open up small banks in those rural communities. Last, here in the United States, a recently opened digital private bank that was intending to serve Black and Latino populations received tens of thousands of requests to open up new accounts in just one day. So we know that demand is there. Simply put, extending financial services to more people is inarguably a good thing.
Indeed, it is. But full disclosure, buyer beware. We do need to go into our investment search with our eyes open. With all the great past success and future potential, we also need to be realistic about some of the challenges. A lack of oversight and inadequate regulation once resulted in a major setback for greater access to financial services. We only have to remember the early 2000s when a binge in microlending in India ended up with millions of farmers with large amounts of unsustainable debt and in many cases, tragic results. As you can see in this article, it's dated this year, February of 2021. The economic contraction from COVID-19 has been felt globally, but the economic hardships, despite stronger regulation, are being felt more acutely among low-income borrowers and microfinance recipients. However, this presents an opportunity for all investors to continue to expand financial services to populations who need it most.
So how do we want to address this opportunity? As Armando noted a moment ago, we seek three specific outcomes from our investments in financial services. The first is increased access to financial services. The world of digitization is expanding these services to tens of millions of new people every year. We want to increase the affordability of these services. Simply put, as we reduce costs, we will widen inclusion and economic participation. And last, we want to build a financial system that helps the world achieve social, economic, and environmental sustainability. We illustrated these three outcomes in overlapping circles because they're closely related to one another and very complementary. As we decrease costs, we will increase access. And as we increase access, we will help increase rates of participation. We do think that improved sustainability in general will increase our chances of success, meaning the planet's chances of success. So our first outcome is aimed at increasing access to financial services to increase or to widen financial inclusion. This table illustrates some typical investment possibilities that we think can help achieve our goals across public and private markets. And one key thing I want to mention in this discussion is that this is about how a single potential investment could advance specific impact considerations and aspirations. This kind of analysis goes alongside of and is part of typical investment analysis about portfolio construction, risk, return, liquidity needs. But here we're focused on the impact potential of any single investment. So as we discussed digitization in public markets, telecommunications providers and mobile providers, that may be kind of a vanilla as far as an investment idea, but mobile technology is the gateway to wider economic participation. People essentially have banks in their pockets now with these mobile devices. Financial technology or Fintech, these are firms using technology and new data collection techniques to extend services of all kinds to new populations. We see Fintech collaborating with banks and telecommunication systems to expand a wide range of services. Speaking of the range of services, unbanked and underbanked people have the same needs as those of us who get to enjoy the participation in formal economy. Basic money accounts, insurance, credit, savings, and opportunities to plan for the future. We're seeing now large multinational insurers who are partnering with technology companies to extend a wide range of insurance projects or products to new populations. Public markets also presents opportunities to invest in new lending sources such as peer-to-peer platforms. This includes direct loans from individual investors to someone who's seeking some additional finance, as well as investment into publicly traded companies who are providing these services. And in private markets, insurance services are growing, often referred to as microinsurance, which caters very specifically to the needs of lower income consumers. We're seeing factoring and trade opportunities in private markets. These approaches help small enterprises gain access to capital through alternative ways of evaluating creditworthiness. Now, as far as targeting the underserved.
Sorry to interrupt.
Yes.
I know we discussed this a few minutes before the call, but I do think we should mention something here about blockchain. And I know you have some thoughts on the topic.
Sure. Thanks, Armando. Blockchain, this is it's a technology solution. It's a huge potential contributor to the growth of all these services I just mentioned. It's essentially a publicly visible digital ledger, and it allows for low cost and secure currency transaction. It's a public good, and it offers creative financial technology or technology companies a chance to compete with major banks on this vast range of financial services. We're not experts on the technology itself, but it is clear that this blockchain-based service will play a big role in expanding access to all these different financial services. Thanks, Armando, for bringing that up. With respect to targeting the underserved, this is straightforward. We just want to put investment resources into the communities and the regions that need it most. There are opportunities across public and private markets in local banks, alternative financial institutions, microcredit, all specifically targeting underserved communities. So with that overview of some of the investment opportunities, let's dive into some data that helps this come to life. First, digital services, we think, are clearly the way to quickly and efficiently expand access. Of the 2 billion people on the planet that don't have formal financial services, 1 billion of them do have mobile phones. This chart shows the steady growth of mobile phones subscriptions over the last 15 years. You can see in that gray bar, significant growth in Asia and the Pacific region. We know now still we're nowhere near market saturation as far as mobile telephony goes.
Will, I'm just gonna add a quick note here too. 10% fewer women own phones in low and middle income countries. And unfortunately, this is typical of many different dimensions of financial inclusion. One way or another, women are routinely excluded from accessing financial services. Sorry, just wanted to chime in with 2 cents there.
Thanks, Mo. That's a critical point here, is the gender disparities in financial inclusion. This next chart shows corresponding growth in mobile money services. That is simple financial transactions that you can do straight from your mobile device, a smartphone, or even not necessarily a smartphone, but a mobile device. More and more people, particularly the poor and the underbanked, are beginning to rely on these services and this wide range of different services they can get straight from the palm of their hand. This chart here shows the global growth in microinsurance. Microinsurance is a way for low-income people to insulate themselves from financial shocks. Injury, death, or health issues can prevent an economic shock to families that are often insurmountable for low-income populations and can really lead to financial ruin. This shows how microinsurance currently is being used. It's mostly for life insurance, but it's also for things like accidents, death, or health costs. For example, again, if a family needs to go to a hospital, a simple policy can prevent that family from exhausting all of its resources for such an emergency. What's remarkable here is there's an estimated total market for microinsurance of 2 billion people, which is tremendously underserved right now. It represents a big market opportunity. Now on to micro lending. This is now a seasoned industry. It's been around for more than 30 years. It's still showing steady growth. And microlending is just extending small amounts of financial resources to individuals or entrepreneurs or businesses who are looking for it. And there's now more and more ways for retail investors to participate and extend those modest sums to borrowers here in the US and abroad. In accessing other sources of finance, the use of factoring has grown considerably in the last 10 years, and you can see through 2025, it should double where we are today. Factoring is one of the more esoteric corners of finance. It's using small businesses' own assets as collateral for loans. Often this kind of collateral are invoices or accounts receivable, and loans can be made against these assets as collateral. This simply constitutes a new way to assess an enterprise's creditworthiness and extend credit to new loan recipients. This map just shows where the underbanked populations reside here in the United States. You can see it's dominated by the southern portion of the country. There's a full 25% of American adults who do not have a formal bank account. Similar map here to show the geography of the world where the underbanked are. It's largely in sub-Saharan South Africa, or Africa, the Middle East, and South Asia. And again, that totals 2 billion people who don't have access to financial services. So that's an overview of how investments we think can expand access to financial services through mobile technology, through technological innovation, and different financing mechanisms that can allow for wider access to these essential financial services. Our next targeted outcome is to increase the affordability of financial services, closely related to our first outcome of access. And in many cases, the investment opportunities are similar and, as I said before, complementary. Underlying objectives here are to reduce costs, to increase participation, and then to help the poorest people avoid their reliance on these high cost alternatives for basic financial services. So who is reducing costs? We see banks that are growing their low cost services. It's like no minimum balance, no minimum fees, and digital banks. We see non-banking financial companies. We're going to discuss these more in a moment. In public markets, as far as increasing participation, we like things like telecommunications firms and mobile operators and other digital infrastructure providers. These are the companies that are getting mobile devices into the hands of new consumers and extending all of these solutions right in the palm of people's hands. In practice, this means things like extending mobile coverage, extending internet coverage, providing digital infrastructure such as that blockchain I mentioned before, all of which help facilitate wider adoption. In private markets, we think greater participation is achievable through companies that are providing financial credit of all kinds to enterprises or individuals, asset-based financing or factoring, those are synonymous. Again, using a company's wider range of assets to evaluate credit risk and extend credit. And then across public and private markets, we see many options to reduce the cost of essential services. Insurance, as I mentioned before, large insurers and private companies are combining forces to expand their footprint in this growing market for microinsurance. And remittances, which is an enormous global industry and is widely regarded as a key stepping stone to financial inclusion because it can invite people to actually attain and maintain a bank account. So if there were more widespread adoption of these low-cost digital solutions for financial inclusion, one important thing we see here, there would be 1.6 billion people, additional people who would participate in the formal financial system, which is a big number. I mentioned there's 2 billion people who are just excluded now. And we could liberate $2.1 trillion in new credit. That's less than half of the 5.2 trillion that these small businesses are seeking, but that goes a long way in liberating new resources for businesses and individuals. And there's estimates that the global economy by 2025 could go up by a total of $3.7 trillion. So there's clearly some macroeconomic benefits from this. So what's enabling an expansion of services and lower costs is one of these varieties of interventions are these non-banking financial companies. These NBFCs, as they're referred to, are largely technology-based companies, and they're providing financial services, but they don't have a banking license. The most fundamental difference is they're not permitted to collect deposits from their clients like traditional banks do, but they provide all of the same services that a bank might. They lease equipment, they provide home loans, consumer loans, they're doing risk pooling with insurance now. Significantly, NBFCs deal directly with clients and they cut banks out of the equation, which helps lower the costs. In this chart, this shows the last 3 years worth of growth of these entities in India, where there's a very vibrant digital ecosystem, which is helping satisfy all kinds of demand for different financial services among the underbanked. I mentioned remittances before. This is a $700 billion market, which is just tremendously inefficient for its users. What's remarkable is the fees that people have to pay to use these services. Remittance fees total tens of billions of dollars every year, and those are paid for by the people who can afford it least. This is largely due to an ongoing dependence on these antiquated technologies and these informal channels. If you think about a Western Union storefront versus the ability to send money directly from one mobile device to another, you can see where the efficiencies might be. The second chart on the right shows something significant, that digital solutions depicted in the yellow bars are significantly cheaper than the traditional money transfer firms in the red. And in the latest year where we have this data, it's half the cost of a similar service that the traditional banks might provide. So we're seeing creative technology-based ideas that are rapidly transforming this particular industry, helping and encouraging people to, as I said, get bank accounts and be formally banked. This chart here shows the steady growth of digital payment transactions, using technology to create wider economic participation. Here in the US, we might think of services for retailers like Square, when you go to a coffee shop or when you buy a sandwich. Or there's Venmo, which allows payments directly from one person to another. But these kinds of services are hugely varied around the world. And as I said before, anyone with a mobile device now can deposit, withdraw, transfer money, or pay for goods and services from the palm of her hand. In the framework that we published, we mentioned an example of a pay-as-you-go solar companies. In this case, an energy services company installs a rooftop solar system in exchange for regular payments made through mobile devices. This skips financial institutions altogether. The customer is paying directly to the solar provider. Apart from providing clean power, these customers that participate in this solution can build their credit histories and they can maintain affordable payments for their rooftop systems. There are more than 10 million such customers that have been served through this approach worldwide. I've mentioned Fintech a number of times today. It's a central figure in extending access and affordability for all kinds of services. This chart shows 25 Fintech startups that already have more than 1 million customers each. Remarkably, this chart excludes Fintech companies in India and China, where the usage is in the hundreds of millions, and it would skew this chart. It simply doesn't fit on this scale. These companies are providing all sorts of financial services, payments, online banking, credit ratings, even portfolio management. The global rate of adoption of Fintech solutions is about 33%. We see adoption rates in China and India, burgeoning markets both, at 69% and 52%. This just goes to show what we think is this global appetite and potential from financial technology solutions. And this slide shows the reasons why Fintech solutions are so popular. Apart from this range of services and features, they reduce costs. 40% of people who transition over to a Fintech-based solution are indicating that they're doing it because they're more lower costs. And so we think this is a significant opportunity to continue to decrease costs and widen participation. So we're hopeful the last few slides illustrate some of the potential for bringing more people into the mainstream by reducing costs. Again, focused heavily on that potential that electronic services can bring. Last, we'll touch briefly on our third overarching outcome, sustainability. The basic background here is that our current global economy creates what economists call environmental externalities valued at over $7 trillion every year. A classic example of this is climate change. If you think about citizens of Pacific Island nations who are now directly threatened by rising sea levels, largely due to the global dependence on burning fossil fuels. You know, there's not a lot of smokestacks in Papua New Guinea, but nonetheless, these are the nations that are going to suffer first and suffer most from rising sea levels. Again, externalities total $7 trillion in added costs for our global economy every year. So we think as we build this next more inclusive economy, we want to find a way to reduce these unnecessary costs in ones that are counterproductive. The headline really here is in that blue bar at the top of this page. It's banks, it's investors, it's financial assets collectively, who will be key drivers of sustainable development or not. So as we invest with this consideration in mind, we are encouraged by a growing body of non-financial data about companies and how they're performing and whether or not they're contributing to our goals of sustainability or not. ESG, environmental, social, and governance data on publicly traded companies is becoming widely available for investors of all kinds. And it can evaluate the extent to which financing particularly from financial institutions, may be financing something that's socially or environmentally harmful. There's an emerging access to finance index, which is helping evaluate the extent to which banks and financial institutions are actually extending services to underbanked community or underserved communities and how central that is to their business. And now there's more and more visibility into how companies are contributing to the United Nations Sustainable Development Goals, where financial inclusion features prominently across all 17 goals. In private markets, investors have even greater leverage in targeting specific impact from their investees and gathering specific impact data, which can inform on progress. And there are many, many more third-party certifications and standards now, which can help verify that a business is indeed doing the work that they say they are, and it's aligned with an investor's intentions. So we think this is rather plain. If we don't begin to integrate issues of sustainability into our financial system, we are doomed to repeat the mistakes of the past and expand all of this inequity that we see today around the world. We just can and we must do better. The last component of our frameworks is to identify how our impact intentions may be undermined and how we could avoid related impact risk. In the case of financial inclusion, this is pretty simple. We want to make sure, for example, that our loans, any financial resources we extend to end users remains affordable. We do not want to repeat some of the tragedies that we've seen in India with microfinance in the 2000s. We want to target local solutions for local needs. And importantly, we want to avoid things like payday lending or providing any sort of finance that we think is going to finance something that's socially or environmentally harmful. So in closing, before we get to some discussion today, we think we could literally bring hundreds of millions more people into the formal economy through low cost and convenient services that meets their needs, which at the moment are entirely unfulfilled. While we do this, we can benefit the global economy. And if we maintain a sense of sustainability in our investment decisions, we will all be better off.
Thank you, Will. And thank all of you for listening to today's Impact Framework on Financial Inclusion. And now we'd like to spend a few minutes on Q&A. You good with that, Will?
I am. I'm looking through. There's all sorts of good questions. Thanks, everyone.
Totally. I've selected one already that looks like it comes from a skeptic. Shouldn't this be the domain of private equity? Can investing in public markets options, as you mentioned, really contribute to these goals? Good question.
Okay, that's a great question. So this really is about whether or not an asset class is better suited to create impact versus another asset class. And we have put quite a bit of thought into this idea. We've published a framework that we think helps articulate how different asset classes deliver impact in different ways. And it's true that private equity provides a more direct and tangible connection to impact creation. But that's not the only way for investors to participate in widening inclusion. And we've been very careful to say that all asset classes have impact potential. And it's not just those ones where you can connect your dollar to a particular outcome that makes impact. As I mentioned, public companies are involved in expanding services through, as I said, the digital infrastructure and through the physical infrastructure. And we're seeing more and more creative partnerships between, as I said, these telecommunication providers and these digital fintech services. So while an investor's dollar isn't as directly connected to the impact results, in the case of public markets investing, there's certainly a case to be made that public markets investing is an integral part of the long-term solution that we are seeking to expand inclusion. And I'll just end by saying on this topic, you know, we think we are witnessing more and more expectation among investors, public markets investors, that companies have to take social responsibility more seriously and address issues of sustainability. In the case of the financial services sector, there is in fact more and more scrutiny on how companies are expanding their services to meet the needs of the underserved. So I think that, again, as investors decide what kind of impact they want and where they want to play, they may very well find that public markets investing is, it does provide a significant opportunity to expand inclusion.
Thank you, Will. There's actually a lot of questions. I'm gonna let you scroll through, Will, but I'll answer in kind of an easy one here because it comes straight out of the framework. Can you provide an example of a telecommunication firm that is actually expanding inclusion? As early as 2007, Vodafone partnered with the digital payment platform called M-Pesa in Kenya to drive mobile transactional banking. Our framework mentions that M-Pesa is thought to have lifted 194,000 people, or 2% of Kenya's population, out of extreme poverty through those mobile banking services. So there is one concrete example there. Will?
Yeah, I've got one. Armando, this is a great question from Trevor. Thank you. How do you see financial or digital literacy impacting these efforts? Thank you for the question. This topic is so big and so deep and so broad that we're not able to cover everything in a presentation like this, possibly without putting you all to sleep. But the idea of financial and digital literacy as an integral part of all of this is essential. Where we're seeing some excellent success is particularly for people who are underbanked. You know, they are financially savvy, but they simply don't have a bank account. They, in many cases, are stowing their resources under a mattress or in a box. And so as they enter into these wider set of services and can make all these different resources available to them, they do deserve and need some training about how to manage it all. There are a number of private equity investments, as well as nonprofit institutions, as well as microfinance institutions, which couple training and financial literacy as a part of any sort of provision of a basic account service. And I think that's essential. We have to make sure that as financial inclusion widens and more people become part of the system, they can do so sustainably and responsibly and meet the success that we know they have the potential for.
Thank you, Will. Another question here on CDFIs. I saw that this was one of your investment possibilities. Can you discuss what these are?
Great. Okay, good. Yeah, I did there was a slide in there about expanding different service providers to underserved communities. CDFIs is an abbreviation for Community Development Financial Institution. And these are essentially alternatives to commercial banks. They're often funded by donors or philanthropy, and their explicit legal purpose is to serve underbanked communities. So oftentimes they rely on sources of philanthropic support or rates of return, which wouldn't necessarily be market rates of return. They're not necessarily 1%, but they're not 7 or 8 or 12% like some people are looking for. We wanted to include CDFIs in here because impact investors also include in foundations or philanthropic investors and some investors who don't necessarily want to maximize the return of every dollar they invest. And CDFIs are in fact a vital tool to expand financial inclusion here in the US. They lend money to underbanked populations, typically people of color or historically disadvantaged populations who are starting a business or who are entrepreneurs. And they're providing essential financial resources to underserved businesses. I think they manage close to $110 billion across the US. There's many hundreds of CDFIs, and they are an excellent high impact opportunity for investors to consider how to expand inclusion.
Thank you. Someone asks, you mentioned big insurers are getting involved. How and who?
Yeah. Well, all you got to do is do a little internet research and you'll find lots of examples. I can think of 2 names. Prudential, everyone, that's a household name in the insurance world, but they partnered with an Indonesian Fintech firm that was extending microinsurance, as I mentioned before, to across the country. Indonesians are tremendously underserved by insurance, and Prudential saw this fintech firm and its reach into these communities with mobile devices, and they have partnered together formally to extend microinsurance across the country. Another one is Allianz. Allianz in 2018 purchased another mobile-based microinsurance company that was started up by a private equity firm, and I know they work in Africa, Latin America, and Asia, and they've reached something like 30 million customers in this partnership with Allianz.
Thank you. I don't want to go too much further here. We have a lot of questions, and typically what we've done is send out an email with a replay of the webinar, and we answer all of the rest of the questions we were not able to answer. So those on shadow banking and cryptocurrencies will hopefully come later. But this as the last question, one I think we can probably dive into with some expertise here from Will. There's a question on sustainability. Sustainability, if there are more customers, does this mean bad consequences for the planet as far as environmental impact goes? So if there are more consumers, does this mean bad deal for the planet?
That's a good question. Yeah, I suppose if we imagine more consumption on the levels that we see in this country in particular, that would probably entail a pretty bad impact. But I think it's reasonable to assume that as more people become involved in this economy around the world, there's a net gain and a net benefit to everyone. For one thing, there would be less poverty, which in economic terms amounts to an enormous externality, which is unsustainable for the planet. I think less poverty, less deprivation are net, better for the economy and better for humans generally. It's interesting, in some emerging economies, we call them emerging economies, they've leapfrogged the so-called developed economies in terms of infrastructure. Many African nations never installed physical telephone infrastructure or widespread electrical grids for a number of different reasons. But instead, they have leapfrogged our infrastructure that we built in the 1900s and they went straight to mobile telephony and distributed solar systems, and just like the pay-as-you-go system that I mentioned. And I think it's reasonable to assume that as the masses at the bottom of the economic pyramid gain wealth, we might be able to avoid this destructive pattern of overconsumption that we're seeing in these so-called developed economies.
Thank you, Will. And thank you, everyone, for listening to today's Impact Framework and financial inclusion.